In the past week, Philip Lowe gave his first speech as Reserve Bank Governor on the topic of inflation and monetary policy. He stated that the easing in monetary policy was not as a result of concerns in economic growth for Australia, but rather a need to guard against inflation expectations falling too far. With inflation across the industrial world sitting well below 20-year averages, it isn't any wonder the RBA has reasons for concern. Essentially, excess capacity or economic slack in the global and domestic economies leads to downward pressure on prices and wages. When there is future expectation for low inflation, increased competition and uncertainties about job security, workers agree to smaller wage increases, if at all, impacting on spending power and future wages, which in turn reinforces low inflation and wages outcomes, and so the vicious circle continues. The RBA has a medium-term inflation target of between 2 to 3%. And from time to time, we will deviate from this, and it is the RBA's job to ensure that it achieves this in a way that best serves the public interest by keeping a close eye on the labour market and Australia's balance sheet. This Wednesday's CPI data for the September quarter will be critical in determining the next rate move, although, bearing in mind, the RBA did note that conditions in the housing market and labour market will also play a role in determining their view on the overall economic outlook and ultimate rate decision when they meet in November. The September labour data released this week showed the unemployment rate decreased to 5.6% from 5.7%. However, more people stopped looking for work and full-time employment did decrease by 53,000, while part-time employment increased by 43,000. Not a good sign, as it shows a continuation of underemployment in the Australian economy. As a result, we saw the Australian dollar sell off from highs above 77.20 US cents and 70.30 euro cents. Meanwhile, in China, economic activity suggests that growth picked up last quarter. Although growth in the industrial and construction sectors slowed, the service sector, such as retail sales and real estate, showed rapid growth. However, Chinese policymakers have been moving to rein in the property market and credit growth. So perhaps the growth number of 6.7% is not all that it's made out to be. That is, China's economy is perhaps expanding slower than the official figures would suggest. The US election